So, welcome everybody. My name's Edward Mangles. I'm the Regional Director for the Asia Pacific of the Fixed Trading Community. So, first of all, I'd like to thank NSE for hosting us today. We've had an amazing response in terms of registrations. So I'm expecting a general trickle of people into the back of the auditorium as we go ahead. But I should also welcome those who are with us online, of which there are quite a few. So, given the time, I'd like to get straight into it, and I'm very pleased and honoured to be able to invite Sriram Krishnan, who is the Chief Business Development Officer for the NSE, just to come and give a couple of words of welcome. Over to you.
Thank you very much, Edward. A very warm welcome to each and every one of you. NSE, like they say, is at the heart of India's capital markets. And the place where we are sitting is a very iconic building, a building that holds a special place in many people's hearts. It is here that the concept of online screen-based trading was conceived. It's here that it was implemented. And this is a place now, 30 years later, where we have all congregated today. India is in a sweet spot at this point in time. And a lot of people believe that the future is very, very exciting, any which way you look at it. A lot of people believe that India will be a 5 trillion economy in GDP terms very, very soon, maybe in a couple of years. And some people also believe that India's GDP will be 10 trillion plus by 2033, if not earlier. All of that means there's going to be a lot of action in India's capital markets between now and 2033. In the last 30 years, we've got about 3,100 companies approximately onto the platform. And if we have to get to the market cap of, let's say, 12 trillion by 2033, given that the market cap of NSE listed companies is already 5.5 trillion today as we speak, then I think we will need to get on many, many more new companies to the platform. So that's a full-time job of a lot of people today at NSE in terms of making sure that we get the right quality companies onto the platform. While we continue to do that, it's also exciting to see the progress India is making in various sectors. And we also have a responsibility as an ecosystem to make sure that we contribute in making each segment much bigger than what it is today. For example, India's commodity space is quite tiny now compared to what it is in many other developed countries. That's an area where maybe all of us have a role to play, make it bigger than what it is today, much, much bigger by 2033 for sure. And that can help. While we go through this journey, obviously, there are always these discussions around the cost of trading, the efficiency, the operating challenges, the tax advantages that possibly need to get created, or any complications that need to be removed, and so on and so forth. It's good to have a partnership going with a counterparty like Fix India. NSE is very happy to work with Fix India to facilitate such meaningful discussions, which can help sort out the agenda items for the regulators and policymakers to take those relevant calls at the right time. So I'm very happy that NSE is able to be a part of this movement. So once again, I welcome all of you, and I hope you have a very productive evening, and I hope you all enjoy the discussion today. Thank you.
Thank you very much indeed. So, straight into our program. We have a short presentation looking at tax and implications for trading under the latest budget. And I'd like to welcome our speaker, Ashona Mesquita, who's a partner of tax and regulatory affairs at Ernst & Young. Over to you, Shen.
Hello. Good evening, and it's a pleasure to be here to speak to you about the recent budget changes impacting foreign portfolio investors. The budget 2024 was announced in the backdrop of a challenging global environment with headwinds of geopolitical tensions as well as inflation. In spite of this, India has always been a bright spot globally. FY 2024 GDP growth of 8% plus exceeded expectations of domestic as well as multilateral institutions. With the concluded elections, we can now look forward to a stable policy regime with a government that continues to focus on, amongst its many priorities, attracting foreign investors. High net worth FPIs in 2024, you can see that it exceeded 44 billion. There has been a slight FPI outflows in the month of October, which more or less has been sort of absorbed by the domestic institutional investors. Very positive outlook for the Indian markets with NSE investor base crossing 100 million investors. Very briefly, to delve into the tax policy for foreign portfolio investors, India is one of the few countries that taxes capital gains for FPIs. There is a self-contained code for FPIs where the income from transfer of securities, be it equity, derivatives, or debt securities, is regarded as capital gains. There's no withholding tax on capital gains. However, investors are required to discharge their tax liability by way of advance tax or prior to remittance of proceeds outside of India, whichever is earlier. There is, of course, a tax, withholding tax on dividends and any interest income. Till 2018, long-term capital gains were exempt from tax in India. This recent budget has increased the tax rates on listed equities. The capital gains from derivative trading is at a higher rate of tax. However, there are opportunities to reduce this tax rate through India's extensive tax treaty network. One of the budget announcements was something that's been a long time coming, which was a comprehensive review of the Indian tax law to make the law more concise, easy to read, reduce, we have extensive litigation pending before all the courts in India, and to provide certainty to taxpayers. And one of the first steps that the government has taken is bringing about parity in the period of holdings for capital gains. We previously had differentiated periods of holding depending on whether it was the type of security or the type of capital asset. Now, anything held for 12 months or less is considered short-term, and capital assets held for more than 12 months would be considered long-term for listed equity. And the rate of tax has increased to 20% for short-term and 12.5% for long-term. This was previously 15% and 10%. The listed debt securities, the rate remains unchanged, and futures and options, it's 30%. I thought I'll get straight into it. And, we have favorable tax treaty networks, which I mentioned, but this requires foreign investors to make sure that they are a person resident in the tax jurisdiction from which they want to claim the treaty benefits. They also would need to have a tax residency certificate, which is evidence of their tax residency. And they should not have a place of a permanent establishment or a place of management in India. Recently, India has also been a signatory to the multilateral instrument, which aims to bring minimum standards around anti-abuse into play. So we've just illustratively taken the treaty with Singapore and try to compare and contrast it with benefits available to GIFT. For those of you who may not be aware, GIFT is a visionary project of the government of India to set up, world-class facilities and to bring financial and technical services within India's residency. So just to compare and contrast the capital gains on equity shares, whether you invest from Singapore FPI or a GIFT FPI. And the GIFT FPI would typically be what is called a Category 1 FPI because it would be regarded as a regulated entity. It would be set up as a Category 3 AIF, Alternative Investment Fund, which means the income would be taxed in its hands. The capital gains on equity shares would remain taxed as per the rates that we saw on the previous slide. However, capital gains on derivatives and debt income would remain exempt under the GIFT treaty. And while this was also exempt under, our Singapore illustration, this would be still subject to the substantiating that the principal purpose of a Singapore FPI is not to the main benefit, or one of the main benefits is not to take a tax treaty benefit. Whereas, that is at a slightly, you would not necessarily need to prove that under the GIFT regulations. Taxation of dividend and interest income is 10% for a GIFT FPI, contrasted to 15% for Singapore. And, as I mentioned, I think the main concern for entities coming in from tax treaty jurisdictions would be the principal purpose test under the multilateral instrument, as well as India's GAR, which finally got effective in 2017, which also casts the onus of the taxpayer to prove that the purpose of a particular treatment was not for tax abuse purposes. There are the benefits as well as regards management fee and the business that the income that the entity set up in GIFT could potentially earn. There are other jurisdictions, similar to Singapore, which could offer a lower tax rate on capital gains on equity, such as Spain and France. Of course, there have been news reports of the French treaty as well being under negotiation. In addition, treaties like, again, Spain, France, the Netherlands, Ireland, offer a concessional rate where derivative and debt income, so essentially non-equity income, would be not taxed in India. I thought what I could do today is very briefly compare and contrast the various modes on which entry into India could be considered. So the very first option is, you have your investors outside India, you set up a stockbroking entity within the India mainland. There's a concessional regime which tax income at 22%, with surcharge and cess. This is effectively 25.17% presently. There's a stamp duty levy on transactions, and this kind of an entity can undertake intraday trading. The second type of entity is your regular portfolio investor or an FPI registered with the Securities and Exchange Board of India, making investments on the NSE and BSE. The tax rates, as we discussed, were 20% to 30%, and a long term on equities could be 12.5%. Cannot undertake intraday trading. An alternative to this is to have a foreign portfolio investor set up within the IFSC, which is the previous slide that we saw, where other than equities, you could have income which is exempt from tax. The rest of the implications would remain the same. And the last option is to set up an entity to set up a stockbroking entity within the GIFT area. And this is the GIFT domestic tariff area, In this case, again, you could potentially have a 22% rate of tax, and an advantage to setting up an stockbroking entity in GIFT is that there's a stamp duty refund, which the government has given as an incentive, where whatever stamp duty is collected, the Gujarat revenue authorities would refund that to the stockbroking entity, which is not something that we'll see in any of the other cases. So that's a brief background on the tax regime for foreign portfolio investors. Thank you.
Hello. Sorry.
Check.
So I welcome you once again to the NSE premises and for the Fix India seminar. We've seen and we've heard some stats from Sriram, and I don't want to repeat them. So I'll straight off go to our set of panelists. So we have one panelist who's joining us online, Murath, who's from Morgan Stanley. He joins us online. I have Suryadeep. He's from Kotak Institutional Equities. Welcome, Suryadeep. We have Anil Gilani, DSP. We have Govind from Franklin Templeton. A warm welcome to you guys. So what we're going to do is we're going to have a poll, and I will need all of you to participate, and that is going to help us to throw questions to the esteemed guest of panelists. So we have real quant traders, we have execution guys, we have the passive fund managers. So we will have a good perspective from all sides of trading. So what you can do is you can pull out your phone, scan the app, and just put in your polls. So which of these factors do you think is playing the most important role in the evolution of quant trading in India? Better and more robust regulatory framework and landscape, technology, which includes both execution and access, liquidity and access to liquidity, and the last one, D, is competition from the industry. So as you poll, we will have these numbers on the screen, and then we're going to grill these guys who've come here in terms of, one, educating us, and second, in terms of giving their perspective. So as we poll, I'll give you a fun question to think over, and we'll answer that as we close the session. What is the common thing between NSE and Fix? And this is something that just as before we started, Ed told me, and this is an interesting fact. Think about technology, think about automation, and think about years. That's what will give the answers. So perfect. We have the answers. You can still keep polling. I don't think this changes much. Okay. And the leading answer to the question is technology, which includes both execution and access. And I probably would throw it open to the panelists in terms of obviously the poll shows that technology I mean, that is the biggest has shaped in India. And, is there anything else that is influencing it?
A little bit of weightage to the other options as well. It's not just technology and technology alone. But my view about technology, and coming from a sell-side electronic brokerage, which is catering to a host of clients, quant trading being one of them. But apart from that, you have the traditional long onlys and the hedge funds and the full gamut of things, the international guys, the local guys. What we have seen is that, and this is something that I fundamentally believe in. I remember a quote from Charles Darwin. When we are talking of the survival of species, it's not the strongest or the smartest which survive, but the ones who are most adaptable to change. So the landscape is changing with the advent of every new sophisticated client. The more the quants come in, the more the systematic guys come in. We see that, for example, giving them a traditional gamut of algos does not really work really well that days. You have to really customize as per their requirements. And the requirements are not only the algos that they're using to access the markets or anything like that, but also infrastructural changes, because the kind of size they're trading, the kind of participation volumes that we are seeing from them is like going through the roof, and it is scales above what we are used to seeing. So we have to know our systems better. We have to know our infrastructure better. We have to go several layers deep. And at the same time, we have to keep in mind that the regulatory framework under which we are working is also evolving at the same time. So it's more of a balancing act, and you have to keep adapting to these changes. You have to know your system fundamentally better and keep on making those incremental changes. So we come up with things like a more adaptive infrastructure, like how well your algo stack is, how it can incorporate changes without affecting things, other parts of the system, more investment into the risk management aspect of it to make it robust and things like that, making sure that the edge cases are handled better and things like that. That's my perspective.
Great. I think, first of all, it was a very engaging way that you started the session, and it ensured everybody in the audience feels connected and involved. I think just to add on to the point which we spoke about technology, coming from the asset management side, where we are using a lot of the algos and the trading efficiency, which friends like you support us with, I strongly agree with this 63% of the voting that definitely all other aspects are fine. I completely agree, but technology is something that is going to be one of the key driver in future. And the reason for that, we were just discussing earlier while having a cup of tea with Rohit and a couple of other friends, that now on NSE, I think we have 260 odd ETFs listed, just as an example. The sheer quantum of the trades that get executed, let's say on a rebalance day, just recently September and rebalance day, in the last 30 to 35 minutes, we had trades worth approximately $6 billion basically, which were flowing through. So just think of the number of lines which are getting run at that point of time. And as the technology becomes more robust, that's the key challenge. How many of you were trading on that day, on that day, either as a sell side or buy side, on the September rebalance day? And anybody saw the huge volume which was getting executed? Sometimes, we were feeling that my fields are not reflecting real time on my screen. Just example I'm saying. And that is currently when there is only 260 ETFs listed on the NSE BSE. Maybe in the next couple of years, these numbers, as Sriram just mentioned, number of listed entities is going to grow manifold. Within that, the quant ecosystem, the trading ecosystem needs a very robust technology platform, which will be able to sustain and help this kind of a volumes to increase and enhance. So I strongly feel that this is a very perfect point and will be a very important driver for the future.
So just to come here, I mean, see, so that it has two aspects, right? So I mean, sell side, buy side. execution and access, right? So for you, it is more access or is it more execution?
For me or what?
I mean, just saying.
So,
I'll come to him.
For,
I'll come
for
to.
I mean, so it's both. One is my execution is very crucial and important.
That depends on him, right?
That depends on him,
Uh,
exactly. So,
right.
and hence I said in the beginning itself that we are heavily dependent on our friends in the sell side institutional desk. Many of the friends over here are very close partners for me, for us, I mean, and we just can't do without them and without their technology platform and the algos that they design for my use. And for all of that, the key is going to be technology.
Got it.
That is what.
Got it. Govind, you have a similar view. I, in fact, have a very different view of in terms of how everyone has voted. So I'll come back to that.
Thanks, Rohit, and rest of the panelists. Good to be here. I think we have a very, I would say, intelligent audience here. I possibly would agree with most of the responses. Possibly I'll give technology 50%, and then yeah, rest of the points equal weightage. So again, coming from a buy side, I look at things slightly more differently from being a global firm as well, because a lot of our technology is globally driven. So a lot of these initiatives are already happening in other offices that comes to India, and we are part of it. So one of the, I would say, big advantage I saw was how technology can really help in terms of looking at data differently. So we have a like dedicated quant team in our regional desk. So when it started, again, typically like being a long only fund, there was a resistance to accept the data because active fund managers will always feel that I think their view, possibly they have a better sense of understanding. And I think as we have seen the rise of quant funds has been last 5-6 years, and market has moved only one way in these 5-6 years. So the real test for the quant funds and the quant performance of quant funds will depend on when markets go the other side, when it really market really kind of crashes, or we have a situation where we have possibly like limit down in few names, like how quickly the quant funds will be able to adapt its style and possibly be ahead of the active funds. So I think that plays a big role going forward, which again, I think technology, like doing those stress test scenarios, how adaptable the portfolios are. So I think technology kind of connects all these dots. So I would say, as Surya said, I think the one who's more adaptable, the quicker, I think will have possibly slight advantage being ahead in the game. So I think all the factors are important, but we have to see how if markets go the other way, how these products perform.
Got it. Got it. So Murat, I'll get you in here. I mean, any different perspective from the panel? And more thing what I want to add is obviously you sit outside. I mean, in terms of general notion is that the evolution of technology happens from the West. So do you think that's how you also look at it?
I'm not sure if that's the case actually. I mean, India, obviously, I hope you can hear me. It's a very robust
We
market.
can't hear you, Murat.
In terms of you can hear me. Perfect. In terms of transactions and the volumes that we see, I think one interesting thing that had relatively less votes here, and initially I did not think about it either, is
just hold on.
Sorry.
That is why I was saying that I'm not really I'm not choosing technology as the most preferred one. Technology sometimes can be tricky.
Can you hear me or no? Can you hear me?
So once we fix that, I mean, we'll just come back to you, Murad. In terms of so see, the topic that we have today is navigating the evolution market, navigating the evolving market dynamics of trading India, including tax, which we've obviously covered, and that's the most important part, and that's why we were listening to the tax consultant first. But it also says quant trading and algo wheels, and I mean, I think many of us will probably understand algo wheels differently. So you want to define algo wheels? What is it for you, or for you and for you?
Yes, Rohit. So I would say we got live on Algo Wheels 3-4 years back because, as I said, a lot of these initiatives are driven by our regional desk. So initially, for even us to believe that, okay, the wheels will be like working the way we want, we weren't really sure about the programming part. The initial part was, again, when we started off, the customization that we did with a lot of our partners sitting here was to see, because the both most fund managers in the buy side, they look at arrival. They punch in an order, they send an order, they look at arrival price. So our effort was to how we ensure we get maximum liquidity at arrival. And then if it gets better than arrival, how do we improve our execution price? So for that, we did a lot of customization initially. Like we said, okay, let's get done some at a price. So we told the wheel, we programmed it in such a way that if I send an order, so the wheel auto selects the broker based on the regression and analysis, like which brokers, which particular strategy type has worked well for us with regards to the TCA. And then it auto routes the order to the broker. So being, say, from a cash desk over the years, it was again a bit of time for us to adapt to it. But then when we saw the results were like actually very good in terms of the wheels beating the benchmark, the TCA, then we had to again customize a bit. So we had like few fund managers who would completely work a different style, maybe over the day. So we created a particular customization in wheels where we put a particular order on wheel. The strategy type, I mean, we have an urgency type, which is the low urgency, high and medium. So the wheel will automatically spread it over the day. So we will almost ensure that we get the VWAP of the day. So I think it's an evolving thing. What I have seen personally is now we are almost 20% of our flow is on algo wheels, which started off being 2 to 5% initially. So we were a very lean team. We were a 3-member desk. Then we lost one team member who retired. So for 2-member team, it was important that we needed a third hand. So that algo wheel provided to be the third hand for us, where we would just leave the orders on the wheel, and then it auto selects the broker. And again, the important part is the partners, the algo electronic guys, because they would know that this is a new technology these guys are trying. So they would handhold the orders. They would ensure, okay, this is possibly off the limit. Would you like to review? So I think it's an evolving process, and I would say the future will be more towards automation or trying to, I would say, so that additional time that we get, we can actually focus in adding more value to the fund managers, be it giving some say stock idea or looking at how the flows are, maybe trying to say sense a direction where markets are heading. So I think it has helped immensely. So which I personally have been a big fan of.
Got it. So just coming to Surya, so you can create a bias for his algo wheel, right? In terms of, I'm saying, the execution that you do, because it's like a reflection of what the benchmark is based on his execution as such, right? Is that a correct way to look at it, or is that a very layman way of looking at it?
So the benchmarks are kind of driven by market data. It's available across the market. I mean, if you have like a third party app like Bloomberg or something, they will basically collate all the trades that are happening and give you a market benchmark, which makes life very difficult for us sell side guys, because at the end of the day, you can have a great relationship with guys all over the street, but the numbers don't lie. At the end of the day, you will be benchmarked on the performance of your algos. And that's where the technological knowledge and the use of technology comes in. You have to know your system inside out. You have to know your algos inside out. Another thing is that here we are also seeing the limits of our innovation, in the sense that when somebody is benchmarking you against an OTD or something like a VWAP curve or something like how good your VWAP is doing, there's only so much you can do as far as innovation in the algo is concerned, because a VWAP at the end of the day is a VWAP. An OTD order is an OTD order, which is slice your order. So you have to go much, much deeper and figure out how the system works, how your system works, and things like that. And that's why technological knowledge is becoming more important. I mean, just to paraphrase, I mean, something like Elon Musk said, it's not about sending faster rockets to the space anymore, but the ability to catch back what's coming back at us, which is creating a several X times of efficiency, which is helping us making a better spacefarer race. So something like that. So you get deeper into the algos, deeper into an infrastructure, you get deeper into your VWAP slices, how passive it is being, how active it is being, how frequently it is crossing the spread. And all these things combined, your focus is on the TCA, and numbers don't lie at the end of the day, but it also helps us guide as in where our focus needs to be.
Got it, got it. Murad, are you good to go now? Okay.
I don't know if you guys can hear me or not, but I'm trying to
We
connect
can
via
hear
my
you
phone.
now very well.
Okay, perfect. The first question, a quick thing I wanted to touch base on was how India actually, when it comes to quant trading, looks different from other markets. In the sense that, for example, if I look at our own flow in general, you will see that India historically has been, say, outside of top 5 market in terms of the volumes that we trade when it comes to long onlys. Now it is a comfortably top 3 market, if not the second market in the region, substantially have grown for long only clients. But if you look at quant trading, I'm talking about purely the cash market here and not the derivatives market. If you look at quant trading, China is by far the largest market when it comes to quant trading in the region. Japan will be a close second. And if you look at these two markets, they've actually taken 2 very different approaches for quantitative funds. It's almost very difficult to access the future. You can't access the futures market as an international quant firm if you're trading China. Whereas for India, it's far more in the FNO space where quants have grown, right? So if you look at the cash market, they're actually, although it has grown 5 times, it still has a lot of room to grow. And obviously, access and regulation has quite a big impact on that, I think. So that is one thing that I wanted to add for the first part. When it comes to algo wheels, what I can tell you from our perspective is they have grown quite substantially for us. Obviously, it creates an immediate observation effect, as what people call it, or the Hawthorne effect, or whatever you call that, right? So essentially, if you observe somebody, their behavior becomes different. When our esteemed, some of our esteemed panelists, our buy-side clients, they watch us, how our algorithms perform and what they do. We obviously are on it far more. We have to perform better. So there's a lot more feedback loop on the back of this that is created. Historically, wheel flow for us has been sub 10%. It has more than doubled over the past couple of years. It is growing in the region. I can tell you that if I look at our top 20 clients, almost all of them will have India wheels. Now, because of some of the regulatory structures in India, they will have India-specific setups as well. So they will customize it for India too. But it is a process that has been grown. I think we're very structural around it to make sure that we perform well. And it's it makes it to some of the panelists' perspective. Obviously, relationship is important, but people directly look at performance, and that creates a feedback loop where you constantly improve your product.
Got it. Anil, you will agree? I mean, given that you are like not the active guy, you're the passive guy.
Sure. Glad I was asked this question. Hello. So, well, I'm glad I was asked this question at the very end, because I was trying to get my mind around it. To be very honest, at this point of time, we have not yet been using algo wheels. Multiple reasons for that. First being that at some points of time, we don't want to give up the judgment of the selecting which broker and which algo to use to the wheel, to be very honest. And second, maybe as Murad also explained from global perspective of different markets, that certain customization for India also is gradually happening. I'm very interested to know how 20% you are using. That's really great. But maybe different areas and different needs have different utilization. At least from my side, I have not been able to yet come to terms whereby in some way, maybe it's just a matter of getting to know more from the friends in the sell side. Suppose if somebody or everybody knows that how my wheel is been designed. That itself is a challenging thing, because then maybe, I'm not saying, but maybe some of the friends in the sell side can try to design certain algos in the best way such that their scoring in my wheel will go up and they will always constantly be up in the curve of the wheel. I think whether it's feasible practically or not, it's open to discussion, because sitting from my side, sometimes these are the kind of questions we have been thinking internally. So we are a little hesitant yet, to be very honest, to have started using the algo wheels. Instead, we prefer to choose our broking partner based on the algos which they are able to provide to us, based on whether they are having SOR or single access. Just example I'm saying, so that is how we like to, at this point of time at least, think about the wheels.
Surya, you want to tell him your secret? Okay. So interesting. In terms of what I thought, in terms of technology being the leader, I think liquidity is something that really gets a lot of people interested, which basically becomes a self-fulfilling prophecy that if you trading the most, you trade more. And then technology becomes an enabler to kind of access that liquidity, because when we kind of and a lot of global players are here, and when we speak to a lot of quant algo trading firms, pure hedge funds or high frequency firms, first question they ask is, how liquid is the market? Okay, because maybe the technology is already there. But liquidity is something that pulls them in, and that's why I thought that maybe technology is just a parallel. It's the pull of the liquidity that kind of gets you developed on the economy as well. So that's what my my thought was. Now coming to the next question, and in terms of the evolution of markets, recently we've had changes, and the regulator has been consistently educating people in terms of what and how it trading should be, and they have come out with the recent measures. How does that compare to the West in terms of evolution? I mean, is there a lot of parallel? Because from a very regulatory point, and NSE is a front-line regulator itself, and we firmly believe that a well-regulated market is something that needs to be developed and be focused on from a long-term perspective. So how does that compare to the West? And maybe I'll add that as well. In terms of what changes do you think? I mean, a sell side, an active, and a passive, and maybe more global. What all changes do you think from now on are needed to get it up and running? Murad, you want to start first?
Yeah, sure. I think given how sizable that market is, particularly around volumes, maybe even open interest, although it's somewhat as smaller, the government understandably is taking a more active role in trying to alleviate any potential losses by retail investors. I do think it is constructive in that sense. And India is a very unique market in the sense that very different to, again, if you wanted to draw a parallel to China, China is a 60% retail market, but that retail access to market is direct. In India, it's more through domestic institutions, right? You have essentially systematic investments that constantly bring flow into the market, which quants find attractive. I think some of the things we could think about would be maybe, there's still some, FPI process still takes a while. I think democratizing that will benefit the market, because currently, if anything, the current participants, particularly the quants, are benefiting. I think having this more democratized will add more participants to the market, which invariably will increase competition between these participants, and that will benefit the retail along with the domestic institutions in India.
Got it. Sell side?
Check. Hello. Finally, something that's working good. Yeah, as a sell side, we are more price takers than market makers here. So in terms of regulations and demands, it's more like, bring it on. We'll try to adapt, something like that. But that said, the more the merrier. I mean, the more liquidity, the more at par we get in terms of strong regulatory aspects, or in terms of access to liquidity, or for that matter, in terms of technological access to also all segments in the market. The more we get towards the larger, more developed markets, the better for us. I mean, it instills a lot of confidence in some of the foreign participants who are accessing our market. It instills a lot of confidence into the domestic players as well. So, in my opinion, it's like only getting better.
I think I agree completely. And even sitting outside, how Murad mentioned, I strongly feel that our regulations are already very prudent, whereby it doesn't stifle any kind of new development or any kind of innovation. But at the same time, it is giving a comfort that, okay, I'm there as a regulatory body as well as a developmental body to aim the way how Sriram mentioned to reach the to make sure the capital market reaches the $10 trillion. And the stability of that platform depends on each one of us, irrespective of what the regulation can mean. So I fully agree with that.
Yes, I think Murat clearly covered. I think this is all evolving thing. I think the kind of education the regulator wants to bring in to bring in those best practices. I think initially it will take whatever, I think, teething effect in terms of settling down on a lot of these things. But I think overall it is only going to benefit each one of us, especially from a foreign investor perspective. It just makes it a more cleaner market. More confidence will be given, saying like liquidity, one of the things you mentioned earlier. I think that's a big game changer in India. So I remember like 5-6 years back, say someone wants to deploy say $200 million. It used to be a big question, how many days would it take to get this deployed? So now I think the kind of liquidity we have seen in the markets, the kind of exuberance, the kind of technology development, to also you need technology to withstand that kind of liquidity and that kind of money coming in. So I think it will only make it better. From I think it makes a level playing field for everyone to see that some of these regulatory framework will ensure that everyone feels comfortable, everyone feels okay, this is someone is watching, someone is ensuring that we are taken care. So I think it's all in the right direction.
Got it. So, coming more from a personal perspective, in terms of you all have spent a lot of time in the market. I mean, what has been your personal learning or growth in terms of how the markets have evolved? I mean, probably when you started versus what you are now, and do you think it's better and better for industry and better for yourself as a whole? Anyone?
I'll start and I'll connect it with the previous question about the regulations and the changes. So when I started, the regulatory framework was already quite robust, but it was evolving. It was just the starting of, let's say, the way in which asset management companies opened up for private sector and insurance companies opened up for private sector. Gradually, how the way in which the retail participation has increased through the institutional platforms like these. I mean, that has been one of the best thing which I have seen in terms of the evolution of the capital markets. And as that increases, I feel we are in a very good position to enhance from the current position that we are.
Govind?
Yeah, I think I've spent like 18 years in the firm, so I have seen initial years where I was part of the operations and technology team. So I've seen the way things have evolved, and last 10 years, I would say there's a big change in terms of the confidence that we have on the systems, the confidence we have on the liquidity, that we can go back to PMs and say that, okay, we can get it done. So that can come only if The other things are taken care with terms to technology, liquidity. So earlier it was 2-3 participants. Now we have family offices, we have HNIs, we have quant funds, we have passive funds. So there is there's a big pool of new players coming in, which makes it even more easier in terms of liquidity. And I think it can only get better. I think if we have certain regulatory framework put in place, and I feel very optimistic about the way I think we are progressing and growing as a market. So yeah, happy about it.
So before I come to Surya, Murad, you have what do you think about it?
In terms of what I learned, I would say one, I think we're obviously in discussions with NSE, the regulators and exchanges in India, but particularly given NSE's leading position, we've been quite a bit in discussion with them. And it's quite great to see how they actually want to work with different participants, trying to make sure that the development of the market is there to support all the growth that India has seen. One thing you learn, I think, over the years that I've been at least at different firms, I always thought I would retire at Credit Suisse, but I guess that was never meant to be, is that you stop getting surprised. I mean, we're quite blessed in the sense that the growth that we see in the region, right? So back in 2008, 2007, China used to trade half of what Japan traded. And all of a sudden, each exchange was trading multiples of what Japan started trading. Now, India is in a very similar position where you see volumes surpass Hong Kong. There's no reason, these are just cash volumes. I mean, it doesn't even involve the derivatives market. There's no reason for it to not become substantially larger. And I think we are positioning as much as we can for that sort of growth. And I think it is quite assuring to see how the industry is coming together to make sure that things actually develop smoothly. When such a large force comes to the market, the risks grow, and we need, I think, NSE's involvement, we need SEBI's involvement more than ever. So when it comes to, for example, I don't know, you will never have settlement issues, say, but if you happen to have one, it could be disastrous. I think having a leading role, like it happens in some of the markets, by RBI, obviously, could be quite important. Having a closing auction that essentially allows our passive clients to be able to track a specific, reduce their tracking error, given India's weight in MSCI now challenges China. It has gone above China. It will represent a bigger portion of their tracking error. So I think working with the industry and being able to, constantly be in dialogue with regulators and the exchanges has been quite a pleasant experience.
Just a couple of things. Firstly, in the last 12 to 14 years or so, one thing I observed is change is the only constant, but the rate of change has kept on increasing massively as we look back at the post-pandemic era. Things have changed massively and for the good of it. So I've seen India be from about 6 to 8% of MSCI to now about what 22, 23% of, and that, honestly speaking, competing directly with China on that front fills my heart with pride. To see the way things have evolved, to see the volumes evolving from India being just another dot in the APAC ex-Japan spectrum to being one of the top 3 markets, being the talk of the town, talk of the region, it's something fabulous, and it really fills my heart with pride.
Good, good. So similar feeling there. So does this also get more competition? I mean, because, as Murad said, China was trading half the volume, then it obviously went up. India is the focus right now, both from an execution perspective and in terms of technology. Is competition increasing because, technology is playing a big part? And how are you kind of playing yourself in that field?
Of course, I mean, we at our institution, we do take it up as a challenge. I mean, obviously the market is really, really sizable now, so it does attract a lot of players which we're waiting for it to attain a certain scale. And now that it has attained, there are a lot of more sophisticated players coming in with their own products and things like that. But we also have been in the market for a while. We have our experience, and we are like fighting tooth and nail to make sure that we give them a tough competition.
Anil? No competition in passive funds?
No, no, I was about to say competition for us as a asset management company is already very significant. We are all aware there is a industry with approximately 42, 44 fund houses and 4 more already in the very close pipeline to get started. And maybe 3 or 4 other global giants who are yet waiting on the sidelines to enter or re-enter into the Indian asset management industry. So I think competition is very evident and very healthy. And we all need to be clear that if we have to really achieve the kind of scale and the size that we are talking about, and if our capital markets and our listed equities are going to go in the region what we spoke earlier, then most certainly any number of players coming in and increased competition is definitely very much welcome. Sir, maybe there are 2 stock exchanges today. Maybe there is a need for third. I don't know. I'm just saying.
No, there is no need for that. So from that perspective, see, I'll tell you, NSE has about 90% market share across segments. There's some segments where we have 100% market share. So while that is good, I mean, 3 might not make sense. But coming to the buy side in terms of just adding it there. So, obviously we heard the sell side in terms of the competition and what is your edge? I mean, Franklin Templeton, why? And same for Murath. I mean, why should we go with you?
Yeah, I think competition, I think without a doubt, the kind of markets are growing. I think there's space for everyone. I think there is enough money there to be, I would say, up for grabs for the AMCs to kind of, that's why we are seeing a flurry of NFOs coming in across the fund houses, because I think you need to create a new segment to deploy that kind of money. So I think the competition is for the good, and for us at Franklin Templeton, I think we are one of the oldest fund houses. Like a couple of our flagship funds are 30-year-old in the country. I think that just speaks for itself in terms of the kind of ups and downs which we would have seen over the last 3 decades. So I think, so I feel like every fund house has their own kind of niche quality or the set of investors they like to go with. So I feel it's a healthy competition, and there is definitely space for everyone to grow. And if we have to kind of compete with China or get to that 5 trillion economy, I think we need possibly more companies to get listed, more fund houses to possibly attract the investments, which can help in the overall scheme of things. By the way, I wanted to check competition between active and passive. How is it internally?
To be very honest, there is not real competition, because we have been very vocal with a very loud voice that it can never be active versus passive. For a very prudent mix in the investor's portfolio, there has to always be a good balance between some part of active and some part of passive. Like the algo wheels, like you said, around 20% of my volume is going through the wheels, which is wonderful. And it's like you said, I'm seriously going to go back and think from my end as well. But it was really amazing to know that. Likewise, we are saying to investors, whether you are a retail investor, salaried employee, large family office, or a large corporate treasury, maybe something like this, maybe 20% of your total portfolio could be prudently allocated to relatively low cost, easy to understand, passively managed funds. And for the balance, definitely you do the focused approach of active management. So I think at least at this point of time in Indian asset management industry, there is no competition. US, definitely there is competition, because now the passive fund AUM have exceeded and crossed the total block of money of the active funds. So there definitely there is a different angle. Over here, at least I am very comfortable. I have no competition from active managers. We are very happily and convincingly and comfortably growing.
I can see that smile and that happiness that gets to your face. So Murath, just coming back to you, I mean, what edge does Morgan Stanley offer in this hyper competitive technology driven service that you offer to your clients?
Thank you. I appreciate the opportunity to mention. Prior to that, though, I wanted to respond to Anil first. In terms of our significant portion of our electronic flow being on wheels, I actually agree with you. I don't necessarily agree that it needs to be that large, to be honest, because, you know, we have moved in a direction sometimes for, you know, cost consciousness reasons or whatever reason that is to you know, be more compliant with MiFID and things like that, where clients send us oftentimes very large orders, right, on wheel, where a wheel order typically has to complete, right? And if it's a difficult order and has to complete, and you put it into a very specific strategy, any broker will complete that order for you, and it will not necessarily be at the price that you like. So I do not agree with the fact, I think it's gone too far in the sense that if a large order is placed into a wheel, even into an algorithm without a human looking at it, typically, you know, trouble will be in store. No matter how good your platform is, your algorithms are, you know, we're using direct feeds, we're using non-conflated data feeds in China, in India, like we do all of these things, but regardless, a human looking at it, typically, even on our side, so we have measures when we look at TCA, for example, how does our algorithmic platform perform? As opposed to for a difficult order where a human is involved, you will see typically a cost savings of 40%, which is quite significant, right? And this number is actually quite stable over time. So that's one. In terms of what Morgan Stanley brings to the table, there are two parts of it. One is access, Rohit. So basically, we have, you know, just like the domestic brokers in India, obviously, they have access to unique liquidity. We have access to unique liquidity on our side because we represent a global client base. And oftentimes we're their sole provider because we have a large prime brokerage house. We have a lot of quant and long short accounts and long only accounts that actually uses Morgan Stanley extensively, particularly on the quant and hedge fund side. That's one side of it. And two is obviously execution quality. We tend to, you know, we have an army of strats. We rank very well on wheels with clients in general. Our platform is designed to utilize market-specific nuances. It is going to have a global footprint. So, for example, in India, we'll use tick-level data, we'll use full book depth, we'll use direct market fees, native icebergs, native IOCs, whatever the exchange provides. If it's beneficial to our clients, we will utilize that. So, I think the inbuilt mechanisms that India exchanges have, we will offer it to our clients. So, you have the two aspects that essentially Morgan Stanley bring to the table. And then the final one will be liquidity access, you know, how we send, you know, do things on the high touch side. Even when we send an IOI, we will look at essentially the potential slippage from sending that IOI to a specific participant, which is quite unique data sets because it's not even an order, you're sending information out. So I think there are all these things that we do in different markets globally that we can bring in when we come into the market, which you know, when we look at the numbers that benefit our clients, and I think that's the differentiating part for Morgan Stanley.
Thank you, Murad. That's a good long set of points.
Answer, yeah. I could go on if you.
So this was the first part. I mean, you know, in terms of how markets have evolved. I will have the second poll now, and I'll request everyone to kind of pull out the phones. And because we are going to see the next 10 years. So the question is, what factors will play the most important role in the next decade for the markets to develop and evolve in the right direction? And think of it from a perspective that, you know, the vision that we have for India. India is going to be a 7-10 trillion economy in the next 10 years, which is going to be a big liquidity pool. So if I kind of just compare a number, normally the market cap of listed companies on an exchange varies to 1.1 to 1.3. So if India becomes a 10 trillion economy, the listed market cap of companies would be about 13 trillion, which would actually mean a lot of companies will come into the market and raise capital and be a part of it. So how will that play? So is technology going to still play a role? Is product differentiation something that will matter more? Will it be the regulations that will take the key role, or is it the human capital? Because is it the trading strategies? Because I hear the amount of money that is going into recruiting the new traders and the coders to get that trading edge in their strategies. Perfect. So products and regulations. Murad, you believe? I mean, you agree with this?
Yes, I do. I completely agree. I think given with the large growth that we see, innovative products will be important. Regulations will be particularly important, I think, for them to not inhibit growth, but at the same time protect the domestic community will be quite key. For example, right? So, people talk about some innovative products like REITs. They've not been too large in other exchanges, if you will, in terms of volumes. Having said that, though, for example, being able to hedge and have hedging instruments for mid to small cap names will, I think, be quite key as the market further matures along the years. I think regulation will play a very important role. Innovative products, of course, is always key, and India is very unique in that space, particularly when it comes to derivative products. It's a leading exchange. Even in the cash market, if you look at the way the market trades, someone who was in Asia trading at a global passive firm who went to the US to trade the US market, famously mentioned to me that US is like a gigantic market that trades very much like India. Basically, that's how we mentioned, which shows how advanced India is when it comes to execution technology. So I completely agree with those two.
Anil?
I'll just share some little different perspective. And of course, product innovation and strong regulatory platform is important. I also feel that the D part or the human capital is also very crucial. So reason for that is that we need a lot of innovation and a very different type of thinking. In general, we are talking about the way in which the development will happen. So I feel for that innovation, the right set of minds, the right set of young talent to come into this field of business, they are the future of finance. So if we encourage, motivate, and create a good platform for young talent to come up, because we are talking about, let's say you mentioned 10 years in future. So I feel that we already have a good, stable, robust regulatory framework. To build upon that, I feel in a very big way, we'll all collectively need to focus on the younger talent pool, the younger people with different ideas who can challenge the existing way in which we are doing business or looking at capital markets.
Got it. Surya and Govind, I mean, one perspective that you can add to this set of questions is, do quant tradings really add value to the actual beneficiary who's the investor? I mean, do you really think that really helps given this question in frame?
I think they do. I mean, obviously, all different products are there to cater the needs. I think I firmly believe that different products, as I think Anil also said about passive funds, I think every set of products will have its own customer base. So I think at some point, they will add value in terms of having those whatever quant modeling, which possibly identifies a particular trend few seconds before than say a particular human can identify. So I think I mean, globally, we have learned a lot of quant strategies in our global offices and have seen the growth that they have seeing at a very high rate. So I think there is I would say, space for a lot of these different types of products. And I agree with Anil with regards to investing in human capital. I think I think we can definitely grow with a lot of other points at the above, but I think you need the right minds and right people behind driving these things. So if we don't have the right people, then a lot of these can get messed up. So I think you have to invest in the right people for the firm, having those. So you never know with the kind of way things are progressing. A lot of tech funds may move into asset management. A lot of, I would say, innovative companies may move into, because it's very easy to tap young people over through app. Like Zomato can say, we will provide you an investment platform. So like you order some food, you can just on a click, you can possibly tap into some investment. So I think to basically compete with all these products, you need sharp minds that will ensure that your own unique position stays and gives you a USP, which is like possibly a brand, a culture that you're part of. So I think, yeah, I think human capital also plays an equally important role.
Surya, you have the sharp minds?
As long, I agree with Govind completely, but as long as they're influenced only by Zomato and not by Zepto and asking for 10-minute deliveries, I think we as brokers should be fine. But that said, yeah, I mean, of course, I agree with you completely. Whatever the quant funds, they have opened up a lot of new perspectives for us as brokers. I mean, they have really put, I mean, given the nature of trading, their whole systematic trading, their trading systems, their algo systems, have challenged us in a lot of ways, and that has helped us redesign or evolve our trading systems better, which always have some pass-on effects to some other client classes as well. For example, now we are equipped to deal with much higher volumes. The capacities have scaled up significantly higher than what it used to be even 3 to 4 years back. It was driven by systematics and all that, and like Anil mentioned, huge rebals and all that we saw. But now, for example, we don't have any problem dealing with many more funds, many more lines and things like that, which used to be a thing of the past. So there are some pass-on benefits. And I agree with the poll. Yeah, I mean, like better regulatory environment, better risk management will always attract more clients, instill confidence into investors to invest more and more. Innovation is something that is always necessary, but at the end of the day, I agree with Anil, it's the human beings who are going to drive this. And we do need to invest heavily on the human capital as well, if you're looking at 10 years into the future.
Got it. So just to add to this, in terms of, we said we need innovative products. We obviously, technology will enable that, and the technology will be enabled by these sharp minds or these human capital. But do you think the Indian market is dynamic enough to have a need for these innovative products in terms of, has that evolved in the West as well? Murat, I'll first get your perspective in terms of how dynamic is the market, because in the US or in the West, it's like Anil said, it's the passive which is ruling, right? Versus how it is in India, which is different. Do you think the market is dynamic enough to take all this, what we think?
Well, the West is also, first of all, I think in terms of the benefits that we mentioned, like whether quant investment is beneficial, if we're talking about one unique set of quant investment, which is high frequency, then we need to recognize that these are self-serving agents. They come to markets to make money. They are not in the market to make sure that retail benefits from it. If we're talking about overall quant funds, say that you have a fundamental strategy and you have a quantitative overlay with it, or you're thinking more sectors, you're not necessarily trying to make money in the next, nanosecond, then these are, in my view, everything I said so far has been my view. I want to make sure that that's clear, not Morgan Stanley's. They're more orthogonal strategies to a passive fund, right? So typically the way I see this is investors use them to actually have diversification benefits in their portfolios. And they're not necessarily latency sensitive either. So there's been clearly benefits to end investors from quant trading. I would not go as far to say that applies to all quantitative trading, which I think why some sort of regulation is always important to make sure that if as and when, say, for example, retail, if they lose money, it doesn't become too restrictive. So having the right set of rules in place ahead of time, I think, will be quite beneficial for the growth of overall trading and activity in India. And one thing I wanted to highlight as well is the cash market's growth in India is going to be extremely important, right? So the derivatives market is very large, but the cash market is where people raise money. That's where actually new companies come to market. That's going to be quite crucial. So democratizing that access, I think, without, at the same time protecting investor base in India will be, I think, quite key for the development of capital markets in India.
Got it. Thank you, Murat. Govind?
Yeah, I think I kind of agree. I think markets being dynamic, I would say like 5 years back, I wouldn't have thought that India would be growing at this pace. The kind of SIP money, which is like $3 to $4 billion every month. So I think the market will prepare itself to be dynamic, to get because the different kind of client need different, I would say, people who are getting into markets, right, from students to elderly people. I think this phenomenon which we haven't seen. So I think because I think the way I think COVID was the biggest factor, I would say, where people did have time, so they started looking at markets more closely. They possibly would have compared being a fixed deposit versus putting it into mutual funds or equities. And obviously markets have moved, so that would have given a token of confidence on how equity can be beneficial in the longer run. And also, I think a lot of these AMCs, I think that the sales teams have also tapped into it. I think a lot of campaigns right across the country. I think so. I would say markets will be dynamic, and India is possibly will adapt to the growing needs of different strategies, different investors.
Well, you think it's different? Passive is the new dynamic?
I think I can't talk about passive all the time. So something different to add to the context as well, that I think definitely we are ready for a lot of innovation, lot of new developments. And very soon it will be the reverse way that Murad will be looking at India and, sir, what's new development you are thinking of, or what your market is looking at, and some type of that maybe we can showcase to our global clients. So I'm sure as our scale and the size and the breadth and the participation of capital market increases, definitely innovation, different aspects, and acceptability of that will definitely be there.
So what you're saying is, as market grows, the dynamism itself will come in and help us.
Dynamism and newer
ideas,
newer ideas,
Yeah.
newer products, something which which currently is not even being thought about by some other parts of the world, will come up from here and gradually get accepted over here, and then gradually globally as well.
Right. That's an important part that, probably, as more money comes in, markets grow bigger, you see a need, and then, you have innovation there.
And certain, sorry, I'll take 30 seconds more. And certain things are already being laid out. Like earlier in the evening, Madam from Ernst & Young very nicely articulated some key differences between some of the large global markets and GIFT City, for example. Many of us are broadly aware, हाँ gift में कुछ करना है, gift में हो रहा है, मेरा gift में एक team बैठता है. But how many are focusing on this type of aspects, and how many are trying to then see how this can overtake, or this can be the new thing which will be the big driver? I'm just saying as a small example. So thanks for that, actually.
Yeah. In fact, I was about to come to GIFT before, but I'll get Surya that to answer the last question. You want to add value? I mean, something on that side?
Yeah, I mean, like the only, I completely agree with all the things that were said. The only thing I want to add is that India has always been the land of not just innovation, but frugal innovation. So we have always been cost sensitive. And there's a lot of thing that goes, when we talk about frugal innovation, there's a lot of thing that goes on under the covers. It's the same thing that's being used, but it's being used with so much cost efficiency that we are probably able to send a rover to Mars at $1 cost, something like that. So it's not seen in your face unless it happens, and when it happens, it wows everybody how they could do it. So there's a lot of innovation, grassroots innovation, if I may call it, happening on that front, on the technology front, which I'm pretty sure will something that will be appreciated by a larger audience very soon.
Got it. And coming back to GIFT, and we had a presentation where Shona did show in terms of how it's evolving. Where does GIFT stand, in the scheme of things for you as institutions?
I would say it's making all the right noises. I think a lot of global fund managers that we have, so we have fund managers sitting in US, Europe, everywhere. So we have been definitely being asked more questions about it, in terms of tax benefits, in terms of the ease of investing in India. So I think it's possibly a matter of time that people will utilize the benefits to it, like as I think Anil was saying, like India possibly will be driving a lot of the global things. Like T+1 initially, a lot of people thought it's not going to be so seamless. But now I think everyone have acknowledged the fact that we are possibly the ones who did it very seamlessly. So I think a lot of these things, possibly it's the way we market it from here on, how some of these foreign investors can be brought into through GIFT. It will create more liquidity for us. So it will create, I would say, more. I would say confidence in the country. So I think it's possibly a matter of time. I think we will see more funds being setting their shops there and start coming through GIFT.
I mean, as in for Franklin Templeton.
So we have we are registered in India. So for us, we can invest through our own entity. So we don't. So it's more, I would say, for getting the new clients to who possibly would want to take the tax benefit or the thing. So I think a lot of sales teams which are working on trying to educate the foreign investors on the advantages of it. So I think it's an evolving thing, and I would say the new investors who would come in would possibly be benefited with this.
Right. Anil, for DSP, where does GIFT stand for now?
Well, for DSP as a house, it's important. We have a FME, Fund Management Entity License, up and running. We have a team sitting physically over there with a couple of terminals, and we are falling short of space, looking for a new office. But in terms of future growth, I'll just share an example of personal life day to day, what makes me feel it's important to be aware of. Like about 8-10 years back, many of the young kids that we were in touch with, बोले मैं Mandarin सीखने का चालू किया है spare time में. Parents are saying, well, what are you talking? China is going to become very big. We'll need to learn Mandarin in future to be relevant in our jobs. Good thinking. Nowadays, most of the kids you talk to, they are saying, I'm learning Gujarati. I'm Gujarati, so I, of course, know it's my mother tongue. But many other in the building compound, in the vicinity or in the friend circle, बोले डॉटर को गुजराती क्लास में भेज रही हूँ मैं. मतलब क्या हो गया मैडम ऐसा मतलब? तो नहीं फ्यूचर में गिफ्ट सिटी में नौकरी चाहिए तो गुजराती तो आना चाहिएगा. तो everybody is planning that way, that now my younger generation will be aspiring to take jobs in GIFT City. So I think that's how on ground thinking is changing about the importance and the relevance and the future growth of GIFT City possibly.
Surya?
We have been looking at it very seriously for quite some time now, and there's a dedicated team looking at it, so they will know the dynamics a little bit better than me. But I mean, if it comforts Anil in any way, I am learning Gujarati as well.
Okay.
Because
So
it's
it's
lovely.
like a validation just on the stage. So it's not just the kids, it's also the adults.
I have some little inherent benefits, so thank God for that.
Sure. Murat?
Well, I'm guessing, me being Turkish, there are a lot of common words between Hindi, at least, and Turkish. So I'm guessing it might be the case with Gujarati as well. I'm not sure, but I often find out when I watch movies. GIFT is obviously very important for us. As you know, we're invested. We push our clients. We educate them very actively. I think the traction on it has been obviously, more significant on the bond market. It's still ongoing on the equity side. But I do think, if somehow there was more clarity around being able to offer swap on GIFT products, that will, I think, be quite a game changer for that as well. It is a very exciting project. We are very heavily invested on it, and we talk to every client about it, really.
Are you also learning Gujarati?
I wish. I think it passed my age, but sometimes I'm on a plane and I see a Hindi movie, and when I look at some of the words, they're actually common in where I come from, right? So my favorite food is Indian, and there are a lot of my favorite people are from India typically over the years that I work with. So I'm guessing I might know some words.
Perfect.
I think Murat has already given mandate to young technology developers in his team to develop an AI-based version of him who will speak fluent Gujarati to the.
Interesting. So last question before I throw it open to the audience, maybe, and I'll put two in there. We said human capital is important. How easy or hard is it to find talent? Because it's a hyper competitive space. And this last, I mean, just to add to it, what is the most scary part of quant trading in terms of what do you think it scares you? And then we throw it open to the audience.
So, how difficult it is to get people, young talent? I would say it's changing. Maybe about 10 years back, it was even more difficult because the job description reads trader, trading, algo trading, and many people for many years used to think of that only and only as trading means day trading, satta kar raha hai, market mein jaake kya kar raha hai, pata nahi. But now, of course, that has evolved greatly. We are having good access to talent, brightest of kids, younger professionals from very premier B schools and IIT graduates are keen to pursue career over here. And I believe that there is a good way in which younger talent is being attracted to this field.
Well, yeah, I mean, it's always been a very specialized field. So getting talent in any specialized field has always been difficult. But one thing that we have realized at our organization over the years is that it's also important to have a very good grooming atmosphere in the team, a grooming culture set up where you take up somebody young, probably a little bit green, not much experience specifically to what we need, but we groom him, train him, and get him ready to be with us and build a culture in a way which is meant for the long term. So we have been doing that, and pretty successfully over the past few years. We have hired quite a few people over the past few years, and we have seen that thing work off. And apart from that, as far as human capital is concerned, I think we need to look at things from a long-term perspective. And when it comes to having roles and new people on the team and things like that, we also tend to think in that direction.
Good.
Yeah, I think it's like almost picking a right stock at right price. So sometimes stock is good, but you are tied up with the budgets of the team. You possibly would want to hire them, but it may not work out from the budget perspective. So I think it's a work in progress. I think as I think the AUMs grow, I think the budgets for these roles also I'm hoping will grow so that we get a chance to tap into right talent. And again, the other important aspect is I think each fund house or each broking has its own culture. So it's also important to get the fitment into the culture because someone should also complement the existing team and also be a strength of the team rather than being a one-man show. I think these things play an important part in hiring. So I think we have to invest good amount of time, take meet enough candidates and then possibly finalize. That's how I would look at it.
Got it. Manoj, your last comments, but the bigger trend, I'll just add to before you go. The big trend that we're seeing in the Indian landscape, especially on the quant side, in the last 1 year, I would say, is that you have a lot of people returning back, setting up funds, thinking of it two ways. One, because obviously there is an affluent market that is there in India now, which wants to kind of divest and use that. And plus, there is obviously liquidity and technology that is playing a part. So that's a bigger trend that we're seeing, and I connected to the innovation that Anil got in. That probably when you have the human capital coming and staying back, and the market growing, probably you will see that. Murat, your last comments, and then we'll have some questions from the audience.
Sure. So I think in terms of talent, there are two aspects to it. So one is Morgan Stanley's side. We have more employees in India than we have in any other country today. We invest in every part of the business in India today. We've made some very important decisions back in the day to move some of the largest IP-driven parts of our platform into India from other countries, which we're very happy about. So there's the Morgan Stanley aspect of things. And then if you look at the quant client base globally, Some of our clients famously mentioned that the opportunity set that we have is not normally distributed, but talent across the globe is normally distributed. It's everywhere. And there's so much more access option for the young dynamic talent in India to become a part of these platforms, learn, from the quant strategies and the alpha strategies that they have, and come back to their country and build their own hedge funds, as you're seeing today, right? So there's more and more of these dynamics that happen globally, which is great to see. So the barriers to entry in terms of talent, in one way, are coming down. There is tremendous competition on the buy side on our client base to hire talent, find new PMs, find great analysts. In India with its dynamic workforce, some of the best universities on the planet is one of the biggest battlegrounds in that field for our clients.
Thank you, Bharat. And now we throw it open to the audience. Any questions? We have the panelists here. Okay, so we have Slido, the questions from there. I'll throw it open to all the panelists. How is AI going to add in electronic trading space? Are there more pros or more cons to it?
Maybe I'll start.
Yeah.
Okay, so
Because you are the executioner, remember?
executioner has a lot of negative connotations. But okay, I'll take one for the team. I'll start on this. AI, the way we see it, is there are two aspects to it. First of all, is a part which is essentially works as a layer on top of our existing product base to help us make better decisions. That is a part which we kind of understand because we can measure those decisions in terms of numbers and TCAs and performance matrices and things like that. The second connotation that's associated with AI is AI basically working as a black box, where you basically give it some query, it works on its internal engines, it somehow conjures up an answer and throws at you. There's no way to cross-verify that and things like that. So the kind of feedback we have received from the street is that more or less unanimously, nobody is confident with such a black box approach, no matter how sophisticated the AI tool that you're using or the AI layer that you're using or things like that. So we kind of are not very keen on that. But other part, which we call AI, which can be a glorified way of indicating some statistical measures that we completely and fully understand, can quantify and see some real world benefits from that. We are open to that, and we are already employing some of this, like a Kalman filters, whether you call it, or based on our past performances, we use some statistical inferences on our curve making procedures to fit our curve performance, curve algos better, and things like that. So those kind of incremental benefits we are already incorporating in our algos.
Govind?
I think, I agree with Surya. I think nothing is foolproof, but believe, so we have some new initiative recently that's gone live. It's called Storybook. So we have like a number of stocks, like 300 plus holdings in our portfolio. So it becomes very tough to have a view on everything. So what we have developed through AI is the Storybook, which gives a pop-up in a Teams chat. So whenever there is some trending story in, say, Twitter, or if there is some unusual volume on that particular day, so which I think is very helpful, because as a human traders, we may not be able to monitor all the 300 plus names at all the time. So it quickly gives us the option to go back to PM saying, okay, we see some activity in this particular name. There is unusual volumes. Looks like there is a good consolidation. Then we cross-check with some of the chartists who are on our sell side, what they view. So it all helps in terms of, as a trader, for me to present myself in front of a portfolio manager. And at the same time, as one funny anecdote too, if I can share. So because a lot of these Bloomberg chats are part of IOIs. So the way you key in. So one day we saw a particular name. It had some like 10 to 12 zeros in the traded volume. So we were like surprised. How can this stock trade so much? But then figured out that there was a B before the stock name, and it just picked up the whatever someone would have shared a phone number or something as a code, and it showed like someone traded so much. So I think there are these I would say teething issues or few niggles that it's a evolving process. But yeah, I think it can help human beings to present themselves in a better way.
So I'll pose the last question to Anil and Murad. In terms of what are the two challenges that quant firms faced in ensuring operational resilience in its technology systems? Different perspectives, right?
Operational resilience, you mean? Well, I think operational resilience, operation challenges, operational aspects are very crucial for quantitative analyst, because one of the key aspects which quant analyst or quant manager would work with is big sets of data, and ensuring the quality of the data and comfort on the data is very important. You might be the best of minds, you might have the best innovative idea in your mind, you might have the best programming skill set, but if the data is wrong, open कहते हैं ना, GIGO हो जाता है, garbage in garbage out. Your model is fine, but the net output is not going to be very useful. So I think this is a very important aspect which operationally as a quant analyst one needs to be very clear and very conscious about.
Got it. Murad, last comment.
Yeah, I agree. I think quality of data is one. Having access to unique sets of data is two. Some of our clients will have thousands of alpha triggers, and the lifetime of these alpha triggers are actually getting shortened per them all the time, right? So it works initially, and then it becomes more efficient, and it stops working, and they need to move on to something else. So it is a constant race, and I think that's the biggest challenge that they face all the time.
Thank you all the panelists here. I will ask Ed to come and give the welcoming thank you address. And we had a great session. I think one takeaway from me was that you will see a lot of innovation happening in India over the next decade, and there's been a lot of talent. I'll leave that to it now. Thank you. Thank you so much. Thank you everyone for participating and giving us those insights.
Thank you very much indeed. Thank you very much to our panelists. We are running late on time, so I'm going to make this very short and sweet. Just very quickly to... Oh, right. Oh, okay. Okay. So just bear with me a moment. Well, just while we're sorting that out, I just wanted to thank NSE again for hosting this. Being able to come to India as FIX and have 2 events a year is great. So thank you very much indeed to NSE for facilitating that. I'm also able to say that Sammy and the conference team have tied down a date for the next FIX conference here in Mumbai, which is the 27th of March. Please put that in your diary, 27th of March, 2025 at the St. Regis Hotel. Please be there. And finally, just to thank you for coming along tonight and being participants in this event. Just to encourage you, rather than just coming to this event and to the conference, get involved in the India Working Group, assuming that you are a member firm. And if you're not from a member firm, become a member firm. With that, I'm going to invite everybody to please join me outside and network with the team, with Pramod, with Govind, our co-chairs, and we'll talk FIX outside. Thank you very much.
So we also have the mementos. If I could ask the panelists to come, and Ed also, you also please be there. I'll present you the mementos. We have the NSE bell, which we present to all our guests. Please.